Welcome to today's Corporate Venturing Insider Series. Today, I'm super happy to have Arvind with us, who was co-chairman of the GCV Leadership Society and who's going to give me guidance as I'm taking the chairmanship for the next 2 years at GCV Society Leadership. Arvind, welcome.
Thank you, Nicolas. It's great to be here. Happy New Year. And, you've already brought so much energy to the corporate venturing ecosystem with everything that you do, that I think it's going to be great to have you as the chairman next year. And I look forward to your leadership there. And I'm sure you'll have fun doing it.
Thank you. Thank you so much. And you also brought a lot to the ecosystem, not just the co-chairmanship, but also you joined our podcast, you've written about corporate venturing, you've been very generous with all of us. But today it's one more chance for you to be generous and share how you see the ecosystem. You have a very interesting vantage points of corporate venturing across many, many years and many investments and engaging with the mothership and adding value. So let me start with very high level helicopter view. How do you see the ecosystem in the last 10 years? How is it matured? What are the challenges still that you see?
Yeah, absolutely. And very happy to be, given this opportunity to speak on this subject. As you know, I feel passionate about this and have been doing this for a little while, for coming up on 15 years here. And it's suffice to say that the environment is so different than when I first started. Um, but one of the things that I tell people is, when we do corporate venturing, for example, when we started Citi Ventures, what we think about is how is financial services getting disrupted? How are startups coming into the area of financial services, and how should incumbents and the large companies think about it? And so we think about changes in financial services. We think about how the market structure is changing, or how technologies are changing, how financial services get delivered. But one of the interesting things is venture capital itself and corporate venturing has changed a lot in those 10 to 15 years. Our industry has itself changed dramatically in the time that we've been doing this. And frankly, for the better. It's a much more mature industry, to the extent that we can call it an industry, right? It's a much more mature practice. A number of companies, understand why they need to do it. That's why the number of corporate venture firms and corporate venture teams have grown dramatically in the last 10 or 15 years. And the other thing I think about, going back 15 years or even prior to that, is corporate venture used to be mostly in the tech world, right? Because it was tech companies investing in other startups that were in the tech world. But as software has come into every industry, and now AI is coming into every industry is impacted by the tech that's happening in the software and AI and all of these different spaces. In other words, the every industry needs a corporate venture unit to make sure that they're keeping tabs on how their particular industry is getting disrupted by startups that are doing different things, leveraging the latest technologies and so on and so forth. So when you think about how, to the question of like, how has corporate venturing changed? One, you can think about the breadth of it. It's very wide and broad now because a lot of industries and a lot of companies are doing it. And secondly, the companies are much more mature, with, folks like yourselves or our team, bringing in specialists who think about this day in and day out, can go deep, can structure it in the right way, can think about how to derive that strategic benefit to the companies that we serve. I think that's become a specialty of its own. It's not a hobby. It's not a side job for somebody. It used to be that way a long time ago. It, no longer is the case. But the other thing about venture capital and corporate venturing, Nicholas, is we live in the venture capital in the tech market like everybody else. It doesn't matter if you're you know, a, institutional venture firm purely driven by financial returns, or you're a corporate venturing unit. You live in the venture capital world. You live in the tech markets. You live in the ups and downs. You have to live through the ups and downs of what we see. And so, we're in an interesting, part of the cycle. In 2022, we saw that sort of downturn. It was kind of quiet for the next 2 or 3 years. And then AI started to pick things back up. And then towards the second half of 2025, leading up all the way to December 31st, you saw M&A activity. And so, we will see if that continues into 2026 as we head into January here. But we live in that cycle. And so one of the things I think about is how should corporations be thinking about that cycle? And that cycle may be different than the cycle for the market that they live in. There may be a mismatch, but you may be in energy and your cycle, it may be very dependent on, for example, commodity prices, whereas, the tech markets and where the S&P may be completely different. So I think there are interesting things to consider there as you think about how a corporate venturing unit is positioned, within this broader ecosystem.
Yeah, and you're not wrong about the activity towards the end of the year. As I shared with you, we had the $20 billion moment with Grok being acquired for licensing and teams with NVIDIA. Now, there's one thing you said, which I want to double click, which is it's no longer a hobby, but at some point you said, if we can call it an industry. So why can't we call it yet an industry?
Well, industry, to me connotes, sort of industry has this manufacturing sort of aspect to this, or at least some kind of a scale aspect to it. I guess you could call it an industry, or you could call it a space or a sector or whatever. But that aside, I want to make sure I congratulate you on sort of the Grok news.
Thank you. Now I want to so the audience is clearly people who are in corporate venturing or people who want to enter corporate venturing. And there will be many CEOs of big corporations listening. And it nearly feels like the question is no longer, can you afford to have a corporate venturing unit? It starts to become more about, can you afford not to have one? Could you make the case as to when a corporation really need a corporate venturing unit and why they should think about it now versus not?
I think I referred to this a little bit in what I was saying earlier about, the advent of technology in every aspect of our lives and hence in every industry, every sector. And I think, if you think back to, for example, corporate strategy teams, you have a corporate strategy team in every large company. You have sometimes strategy teams within the business, looking at sort of various aspects of how the company or the business unit needs to be thinking about growth and changing towards, looking at industry changes and so on and so forth. I think that the one aspect that was missing from those strategy teams, and that continues to be the case today, is they're very good at looking at macro factors. They're very good at looking at, sort of the changes in the industry and some of the, the quote unquote big aspects of strategy, capitalist strategy. But what they're not probably looking at is what's happening in the world of technology that can impact their business. What's happening in the world of startups that impacts their business. And, needless to say that in every industry, you've seen startups come in that have completely changed how some aspect of that industry or maybe the industry itself. And we certainly see that in parts of financial services. And so it becomes an important aspect of strategy, right? I think of these corporate venture groups as being a core part of the strategy function that a company should be thinking about, regardless of where it sits. Sometimes it sits in finance, sometimes it sits in strategy, sometimes it could sit in other places. Regardless of where it sits, it's an important aspect of strategy that a corporation should be thinking about because of how technologies has come into every aspect of our lives and every industry. The other aspect to think about is with the increase in the amount of venture capital, now you have startups going into deep tech and other areas of technology that are capital intensive as well. So there are perhaps industries that are capital intensive that were, um, perhaps not, disrupted, or there was no potential disruption from startups because it was not really an area that startups went into. But now there is capital available for startups to explore virtually every space. There is capital available for sometimes capital intensive things. And so that makes it important for corporations and for CEOs and boards to ask the question, hey, what's happening in the startup world in this area that's going to impact us tomorrow? And I think that that's where the corporate venturing unit comes in and becomes a part of the answer.
Very nice. Let me follow up on one thing you said about it doesn't matter where it sits. I'm sure you do have some opinions about best practices about where the reporting line should be and where it could help the mothership depending on where it sits. Could you maybe share, especially for the CEOs who don't have a CVC yet, but they're thinking about it? How should they think about where it sits and how it should be supporting the rest of the organization?
I think it's a great question, Nicholas, and I think this is an area where no two companies will be similar in sort of how they think about it, because no two companies are similar in their organizational
Mhm.
structure and how they think about these things. I think what is important is that that the incentives are set up correctly, that the team is chosen carefully, and that there is alignment with the business. In our own case, we reported into finance for a long period of time. And then about a year ago, we moved into the chief client office. And as a part of the chief client office, we work with all the different businesses and are very closely aligned with the strategy of all the different businesses. I mean, that was the case even when we were a part of the finance team. But I think that the important aspect is sort of having that permission to engage with all the different businesses, to make sure that you're aligned, to have a collaborative partnership with these businesses, and then be able to have the discussion of what does it mean to have a corporate venture unit, what does success look like, what are the metrics that are important to you, and it may be that one business unit leader thinks of it differently than another business unit leader. And so having that conversation and making sure that you're aligned, I think that that is almost the bigger part of it. Making sure that you have top level support, you have the support from the CEO and the mandate from the CEO to be involved in the activity, but then building that credibility and support also at the business unit leader level, and maybe even below that level where perhaps the product decisions are made, where technology decisions are made, that becomes important, right? And so I think the question around where should it sit, I think it should sit in a place where it has that ability to engage with all the different businesses, the businesses it serves. It should have the ability to en- operate at that strategic level, and then have the right team and structure and financial incentives in place to be able to operate.
This is a golden nugget that permission and ability to engage deeply,
Right.
widely, really, really matters. Now you talk about incentives. So I'm sure now people are wondering, what do you mean by incentives and how are you thinking about incentives that drive the right behaviors?
Right. And when I say incentives, I don't necessarily mean these are incentives for the individuals, though that is important as well. And we can talk about that. But I think, you know, it's also incentives for the team in terms of what gets measured is, what about the financial performance of the unit versus how much of it is the strategic impact that you're delivering to the business? What does that mix look like? Or is it purely strategic and it doesn't matter that have, very poor performance or whatever, but everything we care about is purely on the strategic side? How do you measure these things? And so at the business level and at the level of the team, I'm thinking about incentives to, to make sure that the strategic impact gets delivered with the right financial aspects in mind. I mean, I'm curious to find out how you think about it at TDK, right? I mean, you've been doing this for a little while, and I'd love to hear about that. I'm sure the audience would love to hear about that as well. And then of course the structure determines how the team gets, incented, and we can talk about that as well.
It's such an important question. What does success look like? I think you framed it well, which is really, it's interesting. Many times I go into a podcast and people say, "Oh, TDK Ventures, you are successful," and I always have to remind everyone we are not yet successful. We haven't brought billion-dollar businesses to TDK yet. We haven't returned more money than we've asked. We haven't had our fund returners. And I think before we got this through, I don't think anyone can qualify as a success. I think promising start maybe qualifies, but I wouldn't call it success. And so I always frame the success on our side as, can we really move the needle for the mothership? And when this is the size of TDK with more than 100,000 team members and $15 plus revenue per year, you're looking at billion-dollar moves. You're looking at business companies that really contributes to society, but contributes meaningfully to TDK. And I think our CEO is framing it really the right way, which is it's only pre-financial and financial. And the pre-financial is everything that's strategic that will then turn into a financial impact afterwards. And of course, if we start to return DPI and we return cash, that's financial. That's already in the financial bucket. But everything we do in building equal win partnerships with our portfolio companies and other entrepreneurs and partners, that's in that pre-financial bucket that should drive improved roadmaps, for example, with TDK, better intimacy with future customers, partners, suppliers. So when we think about success, we frame it that way. And when we frame it that way, then the incentives start to make sense, which is the annual cadence of KPIs would be linked to strategic impact, while the financial returns is 10 years in the making. So this would not be in the annual KPIs, but would be more into a financial incentive like a carry. I think that's how we would frame this. But tell me how you've thought about it on your side.
Well, just on this particular topic, I mean, I think it goes without saying for most people that I have talked to in the corporate venture world that that I think both aspects are important. The financial return and financial performance of it is important, but also the strategic impact that you're bringing. And you can say that, look, we exist for strategic reasons. I'm speaking of Citi Ventures, but I'm sure a lot of people in this corporate venture.
La raison d'être, the reason of being.
Exactly. We exist for strategic purposes and for strategic impact. And so we, have gotten good over the years of measuring that strategic impact using different metrics, because not all strategic impact can be measured with metrics or dollars or cents. So I think we've become better at measuring that. I think we could be even better. We can make more improvement, make further progress there. And then the financial return aspects of it are actually the easier things to measure and report on, right? So we do think about both aspects of it. One of the things that I think about, and we see this in our portfolio, and we sort of started to think about it in the way we measure impact, Nicolas, is everybody knows about the power law of financial returns in venture. You have like the big fund returners, and there are a few of those big wins that drive financial performance, and then there's sort of a drop off. And I think that even strategic impact has a power law. I don't know if you've thought about it that way and you see it in your portfolio. There'll be a few of these fund returners as far as strategic impact is concerned. And then you really measure the metrics and the dollars and the cents benefits provided by those few fund returners, strategic impact startup companies. And then and then it drops down, and then there's sort of a longer tail. And so when you look at it that way, you're trying to not measure the same metrics across all of these, across the entire portfolio. You're trying to really hone in on which are the ones that are really working out, because they're the ones that will drive the strategic impact. Because it's the same way in the financial performance measurement, right? You're not looking at, company X and how much is it returning or not. Maybe you're actually going to have a loss on company X, but you don't get evaluated on company X. You get evaluated on, you providing 2 or 3 or 4x return on the entire portfolio. And I think that the strategic impact is probably, ought to be looked at in the same way.
I love the way you frame it. I think VCs understand power law, and I heard Sam Altman explaining it so well visually, which was a power law is this curve that goes exponential. And if you were standing on that power law line, regardless of where you are on that line, looking back looks flat and looking ahead looks like a wall. And I think the point you're making about the engagement that brings strategic values to the mothership will follow the same power law. You will have a very few out of hundreds of engagements you may do over the last 10 years. Very few will really move the needles, but they will move the needle in a way that everyone will remember. And hundreds of them where you spend so much time on. Maybe it brought value, maybe it brought no value, but no one will remember them.
No, that's exactly right. And I think that what you're trying to get to is sort of the business unit leaders really recognizing those kinds of, startup investments, capabilities, whatever it is that you brought to the table, so that, it really then lands on why you have a corporate venturing unit, right? And that has been good to see, because we've been, fortunate enough to have some of those kinds of investments. The other thing, that I think about is just the time frame. You mentioned this in the
I was going to ask about patience, so I think that's perfect.
yeah, and going back 15 years in the very early days, there was kind of this feeling. I mean, in most industries, whether it's TDK or Citi or any other industry outside of perhaps tech itself, they're familiar with startups. They read about it a lot more today than they did 15 years or 10 years ago. And there's awareness of it. And the impression is, and this is true, it's not just an impression, that startups move fast. Startups move fast. They, are nimble. That's why they can sort of do some of the things that they are successful in doing, and so on and so forth. While that is true, the funds move slow. The funds are 10 years, 12 years, 15 years, and before I came to Citi, I was at a venture capital firm called Menlo Ventures, where I've been at Citi for 15 years, but one of the funds that I was a partner in is still active. It still has investments in the portfolio. And by the way, it was not a seed fund. It was a Series AB, a Series AB kind of a fund. And it takes a long period of time for these portfolios to mature, and for them to, first of all, turn DPI, positive 1.0 plus, and then go beyond that. So at a fund level, you need to be thinking really long-term, and which means that as a corporate venturing unit, how you measure performance, you need to be thinking long-term. Whereas many times the business unit leaders are thinking quarter to quarter, right? They need to hit numbers. They need to hit profit metrics. They need to hit, different aspects, and they get measured by Wall Street to hit those numbers. So there's that time element of it, which sometimes can be mismatched. And then the corporate venturing unit and the leader of the corporate venturing unit has a responsibility to explain how that works, so that, it can be, again, set up and structured in the right way.
So let's shift gear towards people who are thinking about starting a CVC. So they would lead that proposal. Hopefully they become the head of that corporate venturing. And let's start with that topic of patience, because corporations are measured quarter on quarter, if not year on year. And like you said, it's a 10-year time frame when you invest in venture capital. And how would you advise that person trying to pitch? How should she think about pitching it with the right message on patience, while the corporation may expect something much more different?
Yeah, and I'd love to hear your views on this as well, Nicolas. But I think that it goes back to a couple of elements we discussed a few minutes ago. One is, this is not a hobby. This is a real part of your it's kind of strategic quiver. This is an arrow in your strategic quiver. You really need to think about it that way. You have a strategy team, you have a corporate M&A team, perhaps you're an acquisitive company, you have an M&A team that's active in helping, execute on your strategy. And then this is an aspect of it, right? And in many places, corporate venture units are combined with the corporate M&A unit, and it's called corporate business development. And I've seen that structure in many places. So, but M&A is different than investing. They're very, very different practices. So saying that this is not a hobby, it's it needs a team of dedicated professionals to help grow it and deliver the strategic impact, I think is one aspect of it that needs to be communicated. And secondly, I think in setting it up, but also in communicating how this is best done. I think the time frame element, right? If we feel that this is something that we might want to do for the next 3 years or 4 years, but then after that, we'll see if it's working out or not. I think that we should, right at the design stage, it should be communicated that this is a long-term business to the point that we were making. This is a long-term business because of course, the financial returns will take time and for the financial profile to mature, but also the strategic impact. You can measure yourself by saying, how many of these companies is working already with my corporate parent, right? How many of these companies are already commercialized? There is a commercial deal, there's a distribution partnership, there is a vendor agreement of some sort. Any of these, you can measure those things quite easily, right? But that's actually the beginning of the story, right? Yeah. How do you then say, well, to our discussion about the power law of strategic impact, how do we then figure out how much actual business impact is being driven by some of these things? That's going to take time, right? And so, preaching that patience and setting it up for the long term, making sure that you're hiring the right people to set it up for the long term, people with an interest in doing this for a little while, because it's, venture capital is an apprenticeship business. You learn by doing, and then you get to see those patterns over time, and that's different than the way the corporation potentially works, right? There are many things within a regular corporation that's also apprenticeship, and venture certainly is an apprenticeship business. So what worked here? Why didn't this work? And sort of taking those lessons and then, learning how to interact with these companies, learning how to make sure that incentives are aligned. All of those things takes a little bit of time. And so I think setting it up for the long run is the right way to think about it, because hopefully nobody is going into strategic or corporate venturing thinking it's a short-term thing.
I think you touch on something so profound, which I confess I totally miscalculated. When I started TDK Ventures, I thought about it as it will take 5 to 7 years to get the returns. And so this is at least a 7-year commitment, which in corporation is a long-term commitment. Typically, it's like 12 duties, maybe 3 to 4 years, and then you move to the next promotion,
Right.
next assignment. And here I was very clear this was at least 7 years. I'm now on my 7th year. And I'm realizing this is not 7. It's actually 15. And if you start a CVC, I didn't think of it this way, but you're going to have your first fund, which we started in 2019. We did the second fund in 2021, which is very straightforward because you start to have some early success and people want to continue. And then 2023 is when we had the third fund and we had some success enough to actually raise it. And we had our fourth fund, but even without the fourth fund, that already committed me to 15 years. It committed me for 15 years because it takes time to return these first 3 funds to get to the point where I can say, back to what success looks like. I've been successful bringing amazing engagement that really moves the needle to TDK, and at the same time return more money. And every time I went to ask for a fund approval to the board of directors of TDK, I personally committed 2x return, cash on cash. Personally, I want to do more, but this is what I committed. I've raised $500 million, and we even have a multi-LP fund part of it. So I've committed $1 billion return, which I know will take not 7 years, but 15 years. That's a very, very long-term commitment. So when you talk about that time frame, I think this is one of my biggest realization, which is I've actually committed 15 years into the same position, the same place, and growing it into something which I hope will really move the needles, both for TDK, but also for all the entrepreneurs we are backing. But this
Right.
is not a 7 years. And if you think about people who are doing extremely well in the corporation, who think that starting a CVC is going to be a really nice stepping stone, they have to be conscious that this may actually be a place that they love so much, they are going to stick to it. And if they want to prove they're successful, this is not 7 years. This is a 15 years gig.
That's right. And to the point that you were making about corporate tour of duty, I mean, I think that many times a good corporate tour of duty could just be 3 or 4 years in a particular position, and then you move on to the next leadership position, and you move on from there. And I think that this tends to be, sort of a much longer than that to actually see the results of it, right? And so you're absolutely right about that. So did all your funds have multiple LPs, Nicholas, or only one of the funds, or?
So I Fund 1, Fund 2, and Fund 3 are single LP. So there's a 2019, 2021, and this year, last year, I should say last year, 2025 vintage. But 2023 is when we had our first multi-LP fund, which is our first thematic fund as well as geographically based fund. So our single LP fund are worldwide across everything that TDK is interested in the long-term strategy. And the multi-LP fund was only for North America and Europe, and only for the energy transformation, decarbonization, energy generation, energy storage, that kind of really very, it's wide, but it's actually really sharp and narrow for the value of our LPs. And so what's interesting about this, maybe I can share to that, is once you start to have a multi-LP mindset, you start to really think about the value you bring to your LPs in a much more granular way. And I think that also drives better behaviors in our teams, more discipline, including on the financial. And maybe this touched to something which I think you and I really agree on, which is there's a forced choice. We talk in the industry about are you strategic or are you financial? And that's a typical forced choice where actually you have to be both. And the way I explain it is financial returns and strategic returns are highly correlated. If I was, we have 50 portfolio companies. We're going to announce our portfolio company we close in December soon. If all of them became what we call unicorns and market leaders, my strategic value would be off the roof. First, we would be a VC number one in the world, but we would also have strategic value of the roof because we would have built intimacy with the future market leaders in 50 different companies. But if all of our 50 portfolio companies went to zero, our strategic value would be very, very hard to argue. Maybe we're not to go, but that would really be tough. But I think the correlation is so high. And I think, and I want you to speak to that, but I think our industry has matured to the point where that forced choice, that question that was asked is no longer asked. And when it's asked, we are very prompt to say, actually, that's not the way to think about it.
I think, Nicholas, you said it very well, and we've had a chance to discuss this perhaps the last time I was on your pod, which is it is truly a false choice because I think the best companies drive not just financial outcomes, but they also drive changes in your industry. And, period, end of story. And so your goal should be to be able to identify those startups that are the best startups in a given area, invest there and partner with them so that you're partnered with the best companies in the space, the companies that are actually likely to change your industry or to, change the way you do certain things or whatever the case may be. And that comes back to your point, which I've, completely agree with, which is, I think it's a bit of a false choice. I think there's very heavy alignment between the two, right? And I think that maybe there are sort of at the margins, you can make slightly different trade-offs and choices. And you and I do this day in and day out, right? Because, we're probably looking at companies every single week, and then we're making some trade-off about, valuation or something else. Um, but 95% of the time they're completely aligned. And I think that that's exactly the right way to think, to think about it. Because, I'll tell you from our perspective, when a company does, and this is from a Citi perspective, when a company does well, not only will they be a great partner to us, whether it's in distribution or bringing a great capability, or maybe, because they are able to solve our problem in like a very significantly better way, right? Like whatever those things may be, not only are they a great partner to us, but we also look at them as a prospective client in the future. Maybe they're going to go public. Maybe they could be a client of the bank for investment banking. They could be a wealth client. The entrepreneurs can be a wealth client. Maybe they can bank with us for their commercial banking needs. So there are all these other aspects of success that are driven by a company being successful. And that's true for our industry, not broadly true. But I think that beyond just sort of the aspect of providing that particular technology capability, I think that there is that aspect of like, a successful company driving outsized returns, both financially and strategically.
Yeah. Maybe touch on something I want to address, which is what I call superpowers. Things that a corporate VC can bring to these startups, which VCs don't have, which is these superpowers that comes from the mothership. Like you said, Citi can bring things to these startups that will accelerate their success, maybe de-risk their go-to-market and so on. Can you speak maybe to our audience who are thinking about doing CVC well, how to think about these superpowers?
Yeah, I think that's a great way to frame that, Nicholas, because I think that, you and I would agree that the corporate venture groups work in a very collaborative way with sort of the institutional VC firms, in a syndicate. You're typically working together in a syndicate. Always, whenever there's a corporate venture, 99% of the time, when a corporate venture team invests in a startup, there are probably financial investors also that are a part of that syndicate. And so, almost by design, we're working together. And I think that every investor, I think that some of the smart CEOs do this very well, right? They build a syndicate with that in mind. Why does venture capital investor one, what do they bring to the table versus number two? And then what is the corporate VC or the corporate VC one versus corporate VC two? What am I getting in return for having them be a part of the syndicate here? And I think, great CEOs can be quite strategic about that. And I think it's, to the benefit of the startup. And so I think, in terms of superpowers that a corporate venture unit brings, I think it's just, a couple of things that I think about. It's the deep domain expertise. That's number one, right? If you're doing something in financial services, I think that we probably have worked in that area and we probably have a business in that area. And I think we can bring that domain expertise on day one. We have, for example, in financial services, people who focus on wealth versus people who focus on retail banking versus people who focus on lending versus people who focus on cards and cards and other aspects and loyalty programs. Whereas, most VCs may have one or two people that are focused on the fintech space and by design and by definition, you need to be more of a generalist. So we bring that deep domain expertise. Secondly, we are able to guide the startup by connecting them to the business unit and to the practitioners within our business. And that turns out to be very helpful to some of the startups that are earlier on in their journey, because they get very, very specific and granular product feedback or strategic feedback that ends up being instructive in sort of how they think about growing their company. And so we've seen that for, several times within our own portfolio, within our own practice. And so that's the second aspect of it. Third aspect of it is you're able to help the company with introductions that are different than maybe your traditional venture investors. I think that we as Citi, we think about sort of our network, our clients of, global 2000 companies and enterprises, and the kinds of connections we can make and the kinds of introductions that we can provide are different than what even a tier one VC can provide. I'm not saying they're better; they're different. And so we think about that. We can bring marketing heft to a startup different than a tier one venture capital firm can, right? So, when somebody says, when a startup says TDK Ventures became an investor, I think that brings that credibility to a startup, compared to sort of other venture investors who are lesser known in that industry, whereas TDK is very well known in that industry. And so that's, the credibility aspects of it. So there are so many things that a corporate venture unit brings to a startup. And I think the smart CEOs recognize that and are very smart about building that kind of syndicate.
If anything, I think cap tables where you have a mix of VCs and CVCs, and assuming that the entrepreneur picked the right VCs and the right CVC, is truly an acceleration of success. And to me, it's reduction of risk if it's done well, and it's accelerating success. And you want that mix of kind of superheroes joining the journey of that entrepreneur. And they all come with different superpowers. But if you choose the right VCs and CVCs at the right time, you end up with a supercharged team of superheroes helping you in your journey as an entrepreneur.
Yeah, that's exactly right. And I think, there are so many parameters that lead to a startup success, that each entrepreneur needs to craft their own journey. But you start with sort of making sure you have the right people around the table. That, not in all cases, but in many cases can be a conscious choice. And so between the tier one VCs, perhaps, that people want to work with, as well as the corporates, I think, that's a choice you're making. And then again, risk reduction and increasing chance of success. I think those are aspects that, corporate VCs can bring to a startup.
Yeah. I'm sure you have the same positive bias, because during your co-chairmanship, GCV got engaged more and more with VCs and invited them to events and making sure they have a voice. I'm a proud Kaufman Fellow member. I've attended after I started TDK Ventures, because I felt I really need to understand venture capital. To be a better CVC or strategic VC, I need to be a very good financial VC. We have one of our team members who are applying for the class 21. So hopefully that will work out. And
right.
I feel like the more we understand venture capital well, the more we are effective CVC. Can you speak to why, especially for those who are in the corporations or thinking about starting a CVC, why the VC part is so important to get?
I think that you're sort of bringing up the point of, you previously asked me about somebody who's starting out anew and saying, hey, we want to set up a venture capital corporate venture unit, and how should they be thinking about it? And I think it goes to sort of what are the two aspects of what we're trying to do here, right? The one aspect of it is the internal strategic alignment, infrastructure, setting it up for the long term, and sort of how you communicate that to the business leadership of the company. But then secondly, and that's maybe, our team is doing it 30, 40, 50% of the time. And then the remaining time you're outside talking to startups, working with VCs, trying to make sure that we're looking at the right companies that are relevant to our business and all of that type of stuff. But in this kind of 50-50 world, 50% of your job is working with startups. But then, going to the aspect of like, how do you get into the best startups and how do you work with them? I think people develop reputations, even corporate venture units develop a reputation. So how do you operate in an ecosystem, right? That's important. And the venture capital world, that's an ecosystem of its own where there are certain sets of players, there are certain processes, certain industry standards. There are certain things that are done, things that are not done, things that are not done that might be done in a private equity world. So it's a world of its own, or if it's in sort of a micro economy of its own and a market of its own. And so being very familiar with how that world works is going to be very important in driving the strategic impact, right? Again, stepping back and saying, we do this for strategic impact. Well, how do you drive the strategic impact? You need to find the right companies, invest in the right companies, have the right kind of partnerships. Well, how do you do that? Well, you need to understand the venture capital world. You need to
Yeah.
understand the world of startups and how that whole ecosystem operates. And so I think that, you know, actually, kudos to you for doing the Kaufman Fellows program after you got to TDK and going through that experience, because I think that accelerates your learning, just in terms of how quickly you can get up to speed.
I mean, I can't speak high enough of Kaufman Fellow and the community it builds and the ability to talk about really tough topics. I mean, we could go very detailed about failures and being authentic about it and being vulnerable about it. But we can also talk about very technical aspects like secondaries, which really is one thing that is so important for CVCs to understand. And by the way, it could help with predictability, which corporations love to see. And this is something that's well understood in VC, and we can discuss it inside the Kaufman Fellow community with this kind of Kaufman Fellow confidential discipline. So we can share that really, really well. And so, but there's something you said, which I really liked. You talked about that 50%. And it's interesting you said that because inside TDK Ventures, we also have this concept of 50% of our time is really strategic VC and 50% of our time is really financial VC. And that's part of the investment team. And we have this program called Board Apprentice, where someone junior at analyst or associate level could come and shadow a board member of our team and learn the ropes, really like an apprenticeship. And one of the questions we ask before we approve it is, do you agree this is part of the 50% of a financial VC? That part, this is no longer about strategic value. This is about your career growth as a venture capitalist. Are you willing to do? So that 50% is interesting because you could argue, no, it should be 10 or 90 or 20 and 80. It's like the yin and the yang, which is also 50-50, where you need to be a very good VC to be a very good strategic VC.
And that's exactly right. And I think where you can afford such a growth, a growth opportunity for younger members of the team, I think it's phenomenal, because then you have a more motivated team and a team that's better trained, and a team that is, better able to actually, at the end of the day, what you're looking for are people who have good judgment good business judgment when it comes to not just the financial decisions we're making, but also the business aspects of things, things that are what's strategic, what is not, what is aligned, what's not. And by the way, is this the best company, and all the other financial aspects of how we tend to look at, investments fundamentally. And one of the things that I used to hear very, very early on in my VC career 25 years ago is you will find, people would advise me that the most, scarce commodity is time, right? How do you spend your time, and how do you, architect your calendar so that you're driving sort of the best outcomes? And so early on, when I was at Citi 15 years ago, I used to track this. How much of it is internal and how much of it is external? And I used to talk about this with my manager at the time, saying, look, there's all this internal stuff I'm doing 20% external, 10% external. Let's create some bandwidth for me to actually be able to spend more time on the outside, because we need both aspects of it, right? To, both aspects of it in a healthy balance for the whole program to work, but also for individuals to actually achieve their career goals.
it's a really good way to frame it. And it helps with ensuring that you can do your job well and brings the impact you want by having that right. I don't like the word balance, but I think it's this duality. You need to be good at both
Right.
if you want to be exceptional. And so I think that's a really good way to frame it. I want to give another shout out. So I talked about Kaufman Fellows, but there's also VC Unlocked, which I did in 2020. So that was my first year at TDK Ventures. And actually during VC Unlocked was when I closed my very first investment with Starship. And it's a joint program between Stanford and 500. And it's 2 weeks. And every year I've sent one or two of our team members. And it allows for a common language as well. And so this is also something I would definitively recommend the audience to consider. Kaufman Fellows is very hard to get to, but VC Unlocked is much more approachable. And it allows to go from ground up and understand the power law and financials. And I think that's probably a good one. But I want to talk about GCV also. And I want to talk about it from a word you used earlier on, which is apprenticeship. And I feel like an industry, and I feel like we're moving from an apprenticeship augmented as an industry with better understood best practices. And so here I would like to hear your thoughts about how do we take this forward? How would you recommend me as chairman, incoming chairman, to really be impacting our ecosystem to become a better industry, behaving better, supporting better the entrepreneurs, bringing more value to our mothership? What would be your advice?
Yeah. Happy to talk about that. And I just want to touch very quickly on something you just mentioned, Nicholas. And I kind of felt like that was a conversation I had a lot in the early days of Citi Ventures, which is how do we support the entrepreneurs,
Yes.
right? I mean, large companies tend to think about themselves and hitting metrics and goals and, hitting their strategic goals that they've promised Wall Street and all that type of stuff. But then who is the champion of the entrepreneur? And it's the corporate venture unit that becomes the champion of the entrepreneur and making sure that it's not just about aligning incentives, but then really supporting the entrepreneur in that partnership and collaboration. And so, that aspect of it is very, very important. But coming to GCVI, I think as the chair of the LSAB, I think there's a really great opportunity to shape the future of GCVI to fit the needs of the venture CVC community, of the global corporate venturing community. And I think that the global corporate venturing, I mean, you talked a lot about the Kaufman Fellows program. I mean, this is almost sort of a analog of that, right? There's a community, and you can think of it as a community because it's not super large. It's grown a lot, but it's still small enough that, to your earlier question, why isn't it an industry? Well, it's still in that size where, um, you know, people can learn a lot from these personal interactions between
Mm.
people. And that's why the community is important. There is no set way to do things. There is, many of the corporate venturing leaders need to figure things out as they go along. The market evolves, and so we need to, as GCVI, serve the needs of the market at that point in time, right? And so one of the things that, Bill and I talked about a lot is what is changing and how do we continue to serve the needs of the GCVI community by making sure that we're staying on top of those needs, on top of those trends. And one aspect of that we brought up, for example, about a year ago, is LP investing. Like, are corporations and corporate venture teams making some LP investments as a way to, give them some leverage, because they have a small team, they don't have people on the ground, for example, in a certain geography. Some corporate venture investors are making investments in other firms as a part of, sort of getting a leverage and multiplying their efforts. You brought up secondaries. That's another aspect of sort of how people are thinking about it, because, these investments end up being, these companies end up being private for so long that secondaries are becoming more important, not just for institutional VCs, but also for corporate venture units. And so those are some of the topics that were brought up. And I think doing a very short survey and maybe doing it twice a year or something like that, to just see where what the mindset is, what the priorities are of the membership of the GCV is a very important, very interesting
Mm.
thing to think about. And then that leads you to, making sure that the GCVI community not just remains relevant, but is, valued and cherished by the members of that community. And then sort of, continue to build that community, the ecosystem, right? And so that's, so keeping current of trends, keeping current of like current industry changes, keeping current of the topics, like LPs, investments or secondaries. Those are all things that I think we discussed it, and I think will continue to be conversations. Exits, right? Now, after a long time, there have been some exits. How do corporations deal with exits? Just like venture investors need to think about how they think about exits, I think corporations need to think about exits. Is this something that you will continue to have on your books for a long period of time because the company remains strategic, or the investment remains strategic, or is this something where you want to get out at the first possible moment? How do you time those exits? Maybe that becomes an important topic in the first half of 2026. So I think staying current and tuning it to the needs of the GCVI community, I think, is important.
And I think it speaks to patience as well, and the value of having people like you and Bill who've gone through many cycles. I think people who are starting a CVC today haven't seen the cycles. Actually, I haven't seen so many cycles myself. You have. And so I think that community of people who have seen the cycles, who can share their learnings from it, is so much more valuable than just being abstract. And so I'm hoping that you stay very involved and we can craft some of the agenda and some of the workshops together.
Yeah, and absolutely, I'm very happy to do that, Nicholas. And to that point, one of the things that we had to deal with, and I'm sure you had to deal with in your own practice, is in 2020 when COVID happened. Um, and we put together a presentation on sort of the impact of COVID in March and April of 2020 to sort of our risk team and our leadership on sort of how to think about the risk of the portfolio in this, in that new reality of April of 2020. And, the perspective that some of us were able to bring to that discussion was having seen through, other cycles. And it goes back to the discussion we had about being a long-term business. Well, yes, it's a long-term business, but then what happens, when the market goes down and is corrected by 20 or 30% and everybody is, really in a very different mindset? I think that creates opportunities. So we talked about how some great companies of today, household names, were created in 2008, 2009, 2010, sort of in the depths of the global financial crisis. And so entrepreneurs, technology trends, those things aren't necessarily following where the NASDAQ is. I think some great companies are founded sometimes in times of economic stress. And those examples help, people understand that you need to have a sort of a consistent fundamentals driven approach to investing, not completely pull back just because the public markets have created, because as we've discussed, it's a very long-term business and you have no way of predicting, what the next 5 years or 10 years or 15 years will bring. And so having a very fundamental driven approach, investing, of course, being prudent around valuations, being prudent around syndicates, all of those things are necessary, but completely pulling back, which is sometimes the instinct when, market softness and corrections happen, is the wrong thing to do. So having a consistent approach is something, is a perspective that we were able to share. And then we kept going, right?
That's such a great golden nugget to end the podcast with. Arvind, thank you so much for taking the time, for sharing your insights and being so articulate and cogent about it so that the audience really can take the golden nugget as they are.
Thank you, Nicholas, for having me. And it was a great conversation for the first day back. I really enjoyed it. And look forward to having you as chair and for great things for the GCVI community.
Thank you very much.